It was news, it hit the markets, and then it bounced right back to where we were. And we've actually been climbing since that news had come out of the White House. And is this something that has to be passed by Congress? Is this something that, is just, an executive order? So there's so many other questions that have to be answered with this. But as rates kind of came down over the summer and you kind of saw that the interest rates have been improving, ARMs kind of caught up. ARMs kind of, started to run past the 30-year fixed as far as better rates are concerned.
I'm Karl Kyler, your San Diego realtor, and we're back with your mortgage market update with Matt Kish of Movement Mortgage. Kish, welcome back. Let's just dive into this for the viewers. Give us an update where rates are right now.
Well, rates are doing their thing, climbing back up a little bit as we start our conversation today. News with Japan kind of fluctuating their economy, and then the big tariff news coming out of the White House towards Europe really has the bond market kind of in flux this morning, as well as kind of the end of last week, even the beginning of last week. Bonds weren't too favorable for us. So interest rates have kind of ticked back up a bit into the lower sixes, maybe mid fives in some cases. So we're slowly creeping out of the fives and getting kind of back into the sixes. But that's just kind of where we've been living the last 8 months ish, right before the summer started. So it's touch and go right now, though, with a lot of the world news, with wars and tariffs and annexations of different parts of the world. There's just a lot of news that's really making these bond markets move with daily news and not like expectations like they normally do. It's the daily feed that's really moving the market today.
Yeah, I can imagine that the volatility in the bonds market is probably bouncing around like a pinball machine. So let's touch on what you referenced, rates into the 5% range. Now, we'll just be real specific. They hit like 5.99, I think is what I was seeing advertised everywhere. So it's kind of like the Walmart price for a 6. But rates came down pretty quickly to that point on announcement of President Trump. I don't know if he was ordering, requesting, advising Fannie Mae and Freddie Mac, two of our largest government institutions, to buy $200 billion in loans, which they repackage into mortgage-backed securities and then sell on the market. Is that about right, how that works?
Ish, right? It's basically taking money, putting it into the bond market, making the bond market move to stimulate that market, right? I was about to say stimulate the economy, but the economy doesn't really need much stimulating at this moment. So the influx of cash into the bond market would lower your interest rates 100%. But what are the other ramifications of that everywhere else? Where's that money coming?
Yeah. So the loan industry, I read on, I want to say it was realtor.com, is a $12 trillion industry. And 200 billion is not a drop in the bucket, but what they're kind of suggesting is that it's not significant enough to really, really move things. And what they advise is that the market response to the announcement was more of a market mover than what 200 billion in loans being bought it would actually equate to. As a matter of fact, they suggested that it's going to do more to move the spread between mortgage rates and the 10-year bond closer together rather than moving mortgage rates down. Is that what you're seeing on the loan side, or do you guys have a different perspective of this?
Truthfully, Karl, we haven't seen any of it, right? It was just news. It was just a snapshot in time. The markets moved a little bit, but they bounced right back up. It was a 48-hour swing. It was news, it hit the markets, and then it bounced right back to where we were, and we've actually been climbing since that news had come out of the White House. So it's really hard to grasp as somebody who watches these charts on a daily basis and takes in the news from Mortgage News Daily, from all of these other entities when it comes to the bond market. And then for one day to have a tweet or a news or something that doesn't go along with the everyday moving average gets thrown in there, it really causes, it's the wrench in the spoke. It really stops things and it really shifts things dramatically really quick. But again, for the dust to settle from that announcement, it took less than 3 days. They bounced right back up. So everybody, it's funny, especially me and you being in this business, when you go on your social medias and you're friends with real estate agents and loan officers and title officers, and everybody has this information. You see everybody blasting, look at where rates are at, look at where rates are at. By the time we're able to catch our breaths, the rates had already jumped back up a quarter of a point. So again, it's ebbs and flows with the news cycle these days, but the economic ramifications of it are yet to be seen, because again, it was just news. It was just a blip. It hit the market, and then as quick as it came, it went. So I don't think I answered your question, because there's really no way for us to be prepared for, just obligatory news swaying these markets so much.
Yeah, that is 100% very, very fair. It's only news. It's just Trump announcing, some random statement along with what kind of cereal he's eating that day, and it swings the market. And it's so funny that you mentioned this. All these agents and realtors are posting online, and then it was like, but after the weekend's over, rates are different. And I still had clients contact me, oh my God, are rates gonna come down? Rates gonna come down? And I'm reminding them, it's only an announcement. It is not something that Fannie Mae or Freddie Mac have agreed to do, or we don't even know where that money's gonna come from. There are economists online that were looking at the net sheets, and they say, oh, well, they're gonna have to issue bonds and blah, 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 and that. Like, how are they gonna resource the money to buy 200 billion?
And is Congress, and is this something that has to be passed by Congress? Is this something that, is just, an executive order? So there's so many other questions that have to be answered with this influx of cash from the government in, buying and selling their own bonds. But for instance, if the White House came out and said, we're allocating $200-300 billion from the war budget and putting it into mortgage-backed securities, I have a feeling that would be a train most people would jump on, and you would see rates kind of come down, because now we're allocating where the money's coming from. That's good news, because we just said we're putting 50% more back into the military. So, and then the bond shot up because of that news. So again, if this money were to be coming from places that we knew, and it was allocated by Congress, and we had a plan for it, then you would see the expectations in the bond market the way that you should. But because we don't have a plan, it was just a knee-jerk reaction with news. You saw it come and go as quick.
Yeah, absolutely. And I like that point that you make when there is more detail of like where the funds are going to come from. To put things into context, when the government was buying loans way back, this was going to be prior to 2019, they were buying 40 billion a month is what I read. Where now it's not, I think some people misunderstood this to be 200 billion a month. And I don't think that's what Trump was trying to allude to.
No, not a month. It's just one insurge of that flow, and then see what that does in the bond market, right? Let's it's one of those, let's throw it at the wall and see if it sticks. And I don't think it stuck.
Yeah. And along with, so he's got this effort to buy, or this idea to buy 200 billion in mortgages for Fannie Mae and Freddie Mac to do that. Then he's got a portable mortgages that will transfer. And then he has a 50-year loan. So it's really like he's just swinging at anything right now to see what will stick. And then if it does, maybe he'll push to there, or maybe we'll just hit this soft landing that the Fed's been trying to engineer for the better part of half a decade, and we may not need any of this. With that being said, let's move into loan programs, because that was a very rate sensitive topic. Rates are the main discussion of everything right now, because it directly ties to affordability, right? So I regularly see like 30-year conventional, very, very textbook, right? Low down payment, we have FHA. No down payment, we have VA. FHA, VA I think those are sub 6% right now. Conventional is slightly above 6%. Then you have these ARMs. How was it again?
Adjustable rate mortgages.
Thank you. I had active rate mortgages. I knew that wasn't correct. So you have these adjustable rate mortgages, which they have this bad stigma associated with the 2008 world financial crisis, where you had these loans that were 2 years maybe they had some that were 3, I can't remember, it's been a while now, but typically it was a 2-year interest only loan, and then the rate would adjust after the 2 years. We peaked in, we really started to flatline in 2006. Like we saw all this starting to unravel in 2005, but we flatlined in 2006. As these loans came due, people could not refi out of them and they just got stuck. Can you tell us, what are your thoughts? I see this 7.6 ARM on Mortgage News Daily where the rate is lower. And is this a viable option? Are ARMs a reasonable resource for someone who wants to? And I see the difference in payment, like from what they announced there between a 30-year conventional and the ARM option, it's like $140. So it's not like a big difference every month. But is this something that you guys are advocating for? Is this something that you see the market's maybe not ready for, or is the market moving to it? What are you seeing on your side for ARM loans?
We're always being asked about ARMs, and I'm always giving ARM options. But for the last 5 years, ARMs and 30-year fixes have pretty much run side by side, right? And in most cases, 30-year fixes were less expensive to obtain than an adjustable rate mortgage. But as rates kind of came down over the summer and you kind of saw that the interest rates have been improving, ARMs kind of caught up. ARMs kind of, started to run past the 30-year fixed as far as better rates are concerned. But again, these ARMs, they adjust. So that really has to be a conversation. If you're really serious about an ARM, it has to be in the plan. What is your plan, right? If your plan is to sit there and raise your family and to live in this cul-de-sac home for the next 20 years, getting into an adjustable rate mortgage, I would strongly suggest against, right? If that's the plan, because in this market, rates are still really volatile, right? So getting into an adjustable rate mortgage in a volatile rate market, probably not something you want to do, but we're going to have that conversation. But here's on the flip side. If you know that you're being deployed, or you know that because of your job, you're only going to be in a geographical location for a finite period of time, 3 years, 5 years, 7 years, before you got to pick up, sell, and move on to the next, then maybe these ARMs are something you want to consider, because you're going to be out before it adjusts, right? Or what is the rate market today? What does it look like going forward into the future, if we can foresee that far, right? If you are getting into a 5-year ARM, could we foresee what the rates are kind of doing, or even back it out and see what the rates did the last 5 years? You probably can't do either of those, on today's ARMs, because the last 5 years have been really tricky as far as rates are concerned in overall time, right? It's a pretty, unique kind of rate market that we were in pre-COVID. So you can't really back out that picture and forecast what it's going to look like for the next 5 years. So again, like, it really has to fit what you're doing in your life to really make these ARMs make sense. Unless you're just a gambling person, you're just like, I don't care, Matt. Like, I want the lowest rate today. And if it's an ARM, that's what I'm going to live with. Don't care about the ramifications. Then again, like, that's you. That's your option. That's the way you're going to put your foot forward for your financial future. And that's fine too. But I'm always going to have that conversation, weigh out the pros and cons. But again, if you're a first-time home buyer, and I know that affordability is a thing, and you've been trying to get educated on interest rates, and you see that the ARMs are lower than the fixes, I'm probably going to try to talk you out of it, truthfully. Especially in this rate market today. Like we said, I mean, 2 weeks ago, rates were looking like they're getting better, lowest we've seen. And now today, man, they're hurting, right? And bad economic news seems to be on the front line because of what's going on with, the way we're trying to conduct ourselves around the world. So it's probably not a good time to get into an adjustable rate mortgage if you're looking to be in that home longer than the term, right? If it's a 5-year and you think you're going to be there for 9 years, probably going to want to look into a fixed rate mortgage, right? If you're going to be there for 10 years and you got a 7-year, looking into a 7-year ARM, probably going to want to look into a fixed rate mortgage. But if you know you're going to be out in 5 and we're looking at the 7-year ARM, yeah, that makes sense. Like, you're going to be out 2 years before it adjusts. Let's talk about that.
Got it. So they have their place but it's really for those whose expectations of staying with that loan are going to be short term. So I think of like for first time buyers, or maybe just like entry level buyers, I shouldn't say first time, but people who are like looking to move into the attached market, who have the vision of getting into a detached home and, you know, using this condo or this attached home to get into a detached home. And if their goal is to be there for 3 to 5 years, a 7-year ARM might make sense until, you know, maybe rates settle, and then they can always refi if another opportunity presents itself. And it gives them that little bit of a buffer, very, very little. Mind you, I said earlier, it was like $100-ish difference, but you know, $1,200 a year, I don't know, apply it where you want, but it gives them that little bit more breathing room, especially as they're settling into home ownership with a first home or a smaller home, and then allowing them to move up. So, okay, thanks for clarifying that. I'm glad to hear that it is on the table. Not surprised to hear that a lot of people aren't moving towards it, but it looks and sounds like you are approaching it in the appropriate way with regards to how the buyers can leverage the tool and who it makes sense for and who it doesn't. So if you have any thoughts, questions, concerns, if you want to explore your loan options for yourself, I have Matt Kish's contact info in the description below. Feel free to reach out to him directly. He's here in San Diego. It's one of the reasons I work with him, not just because he's a good guy, but he's also local. That's important to a lot of people that are buying here. They want someone who kind of has their ear to the ground, that knows what's actually going on. And one of the biggest mistakes you can make is working with a lender from God knows where in the country that advises you incorrectly in a local market. So thoughts, questions, concerns, contact Kish directly. If you have any thoughts, other thoughts, questions, concerns for me, don't hesitate to reach out. As always, I'm Karl Kyler, your San Diego Realtor. I'll see you in the next video.